This is a BC Eagle Finance video, Brigham and Houston, Chapter 3, Learning Objective 4, Statement of Cash Flows. Statement of cash flows is the financial statement that shows where the company got its cash for the past year. Here is an example of the Allied Food Products Statement of Cash Flows for 2016. The Statement of Cash Flows is broken into three distinct sections. The cash flow from operating activities, which represents the cash flow from doing the business that the business is designed to do, its core activities. The cash flow that comes from investing activities, which represents the buying or selling of long-term assets. And then the cash flows from financing activities. These would be cash inflows or outflows from issuing debt or issuing common stock. And then there is a reconciliation section that takes the change in cash for the period and compares it to the beginning cash to reconcile to the ending cash on the balance sheet. Take a minute to look back on the balance sheet for the Allied Food Products from the last video and note that the 2015 ending cash was $80,000 and the 2016 ending cash was $10,000. The statement of cash flows will always have a balance that is the exact difference between these two cash amounts. Here are some questions for Canvas discussion. What is the statement of cash flows, and what are some of the questions it answers? Identify and briefly explain the four sections shown in the statement of cash flows. And if during a year a company has high cash flows from its operations, does that also mean that the cash balance on its balance sheet will be higher at the end of the year than it was at the beginning of the year? Can you explain why this may or may not be the case? Learning objective number 5, the statement of owner's equity. Let's look at the Allied Food Products Statement of Owner's Equity for December 31, 2016. The Statement of Owner's Equity is designed to show shareholders where their investment was at the beginning of the year and how it changed through the year to show the end of the year shareholders' equity. Essentially, the statement of shareholders' equity turns the balance sheet on its side. It shows the shares that the company started the year with, the amount of book value of those shares, the beginning of the year retained earnings, and when you add the stock plus retained earnings, you get the total shareholders' equity at the beginning of the year. The next section of the statement of shareholders' equity shows you why amounts on the financing side of the balance sheet changes. For example, retained earnings changes because of two reasons. One, the business earned income, and in the case of Allied Food Products, the company earned $117.5 million. And you can agree or check to make sure that this item ties in to the net income on the income statement. Additionally, Allied Food Products declared and paid dividends of $57.5 million. Distributions of net income to owners reduces the amount of income that the business retains. So beginning retained earnings plus net income less dividends would give you the ending retained earnings that appears on the balance sheet. On the contributed capital column, if there were any issuances of stock or if there was any repurchases of treasury stock, the increases from IPOs and the decreases from treasury stock purchases would appear in this column. Questions for Canvas discussion. What information does the statement of shareholders or stockholders' equity provide? Why do changes in retained earnings occur? And can you explain why the following statement is true? The retained earnings account reported on the balance sheet does not represent cash and is not available for the payment of dividends or anything else. Can you really describe what retained earnings is? Learning Objective 6, Uses and Limits of Financial Statements. Financial statements are principally used for disclosure of corporate information to the owners and debt holders of the corporation, essentially information for the providers of capital. Providers of capital are interested in seeing whether the corporation has the income to pay them back a return on their investment in the corporation. In addition, the financial statements show the resources or assets that the company has to generate its income, and secondly, how the company financed those long-term assets. Was it through debt or was it through stock? Third, financial statements show the owner's claim, known as a residual claim, on business resources or business assets. The owner's equity represents the amount that the owners could claim in case of bankruptcy, in case or if the business went under and the assets could be sold for their book value. Also, the financial statements show cash flow, where the cash increased or decreased because of operating activities, financing activities, and investing activities. The limits of the financial statements is that comparing one company to another company may not always be straightforward because U.S. GAAP, generally accepted accounting principles, permit different accounting methods to account for similar types of transactions. For example, one company might use a FIFO inventory system, first in, first out, and a competing company might use LIFO to value its inventory, last in, first out. The first company would show higher inventory values on the balance sheet, but less cost of goods sold on the income statement. The second company using LIFO would show less inventory on the balance sheet, but more cost of goods sold on the income statement. To compare these two companies, the financial analyst would need to adjust inventory so that both companies would report either FIFO or LIFO for comparison purpose. Secondly, business managers have a good bit of discretion for the amount and timing of asset write-downs to their fair value. If certain assets have become impaired, the business is permitted and actually required to write down or reduce the book value of these assets to the fair value. The timing of when they do that and the exact amount of the write-off is subject to a lot of discretion, so financial analysts carefully scrutinize those write-downs. And finally, another limit is that accounting report information needs to be adjusted for finance emphasis, especially for the operating cash flow after tax, often called NOPAT, net operating profit after tax. Finance types are interested in the cash flow from operating activities and not necessarily the cash flow after all financing costs are considered. We will discuss this concept of NOPAT, net operating profit after tax, in a later video. Here are some questions for discussion. Can investors be confident that if the financial statements of different companies are accurate, that means the numbers are correct, and are prepared in accordance with generally accepted accounting principles, that the data reported by one company will be comparable to the data provided by another company? Why might different companies account for similar transactions in different ways? And can you give an example of a company that has done just that? This is the end of video number 2 for Chapter 3. Thank you for listening.